Hello everybody, in this video we'll be starting with the chapter number 26 of CMT Chartered Market Technician Level 1, and we are starting the chapter 26 Exchange Traded Products. In this chapter we'll basically be seeing what are exchange traded products and what are the various kinds, what are the different types of exchange traded products other than our usual securities, what else are there, and how can a person like you and I trade in them. Before watching this video, in case you haven't watched the previous chapters, then make sure to check the description box below and watch the other chapters as well, as it will be very helpful. So in this chapter we'll be discussing how to define an ETP. When I say ETP, I'm talking about an exchange traded product. Review differences between ET funds, which is exchange traded funds, and exchange traded notes. What are the difference between the both? Describe the uses for leveraged ETPs. So these are the three things which we will be seeing. So first let's discuss what exactly are exchange traded products. So investors are taught to diversify their portfolios to spread out single stock risk. So if I have a lot of capital with me and if I put my entire money in just one stock, that is basically very risky, right? I need to diversify my portfolio. I need to divide my capital into different portions, and I need to allocate them properly. So a portfolio of more than just a few positions gets difficult to manage. If I have like 100 stocks, again, just because I'm saying that you need to diversify your portfolio doesn't mean that you have 100 stocks in your portfolio, because it will get very difficult to manage, and you need to keep rebalancing them, or you need to keep replacing the stocks and stuff like that. So those are things which you need to again keep in mind, right? So what are mutual funds? Mutual funds are some experts who are basically managing your funds, and that became really famous, right, for this only. Okay, so mutual funds had their limitations. Let me start with my exchange traded products. So exchange traded products were introduced to overcome the problems which are faced by mutual funds. Okay, so what does ETP do? ETP basically reduces the costs and gain more favorable tax treatments. I will be showing you the PDF of this chapter, and we'll be doing this chapter from there only. Okay, so I'm over here. Exchange traded products were introduced to overcome these problems, streamline the process, reduce costs, and gain more favorable tax treatment as a bonus, because they trade just like stocks. So if you are trading in the Indian markets, if you go to your trading view and you search Nifty Bees. Now Nifty Bees, Nippon India Nifty Bees and all of this, these are basically exchange traded products only. So there are various exchange traded products like these listed in the market, right? So the most popular ETP are exchange traded funds. So ETF, the Nippon which I just showed you, the Nifty Bees, so you have various funds like that. So ETF is again exchange traded funds, and ETFs are a type of ETP only. So the sponsor of the ETF, or who is the sponsor of the ETF? The contractor. They own shares of the underlying stocks and other assets, and they makes share of the portfolio available to the public. So how many shares they have? They have already bought 100 of it, and they are giving to the public little bit of it. Okay, so ETP codes also look very similar to the stock codes. So like I just showed you the Nippon Nifty India chart, it looks normal only, right? It looks like any other chart only. So what is the benefit of ETP? Now what benefit do I have when I put my money in an ETP? So benefits again depend on the specific ETP. If I have a chance to invest in my gold ETFs or silver ETFs, or let's say pharmacy ETFs, so there are various kind of ETFs like that, and there are various benefits of everything. Some allow the investor to own an entire sector of the market rather than having to choose. So if I want to buy all the stocks in the pharmaceutical sector, it's not possible, right? But if I want to do so, I can buy a ETF of the pharmaceutical sector. In that case, all the stocks are given equal value, or all the stock there is a proportion of every single stock in the ETF or pharmacy itself. So that is one of the advantage, that if I want to own an entire let's say sector, so I can do that. Let's say as an investor, I believe that in the next 2 years pharmacy in the sector is going to boom. So I don't know which company is going to boom, right? We don't know which specific company is going to boom. I just know that the sector overall is going to boom. In that case, I can purchase an ETP of the pharmaceutical sector. Okay, so I hope you understood. Another benefit is automated tracking of changes to the underlying index. The ETP sponsor adds and subtracts components and adjusts weights so that the investor does not have to worry about doing it. So if a stock is doing good, I'll keep it. If a stock is doing bad, I'll remove it from my ETP as a sponsor. So all that the sponsor only does it. I don't have to do all that. I don't even have to worry about rebalancing, because all that is done by the agent or the sponsor itself. So these are my benefits as an investor. Okay. Now ETFs are exchange traded funds. I just explained that to you. Now there is something else which is known as ETN, which are exchange traded notes. Now let's see what are the difference between them. The major difference between ETFs and the ETN is what the fund and the investors actually owns. So in ETF, what happened? ETFs own the underlying assets and investors own shares. ETNs are structured products that are issued as senior debt notes. The holder of an ETN owns shares in a bond backed by assets. So what are the difference between ETFs and ETNs? So ETFs underlying are the stocks, right? Whereas when you are talking about ETN, the underlying asset in an ETN is basically a bond or the government securities. That is the only difference. So ETFs are, the underlining of ETFs are basically stocks and other securities. When we are talking about ETN, the underlining is the government bonds. Okay. In terms of technical analysis, the difference is negligible. However, should the products fail, the holders of each have various different remedies. So many ETFs track stock indexes. So they've given you some examples of ETFs. The way I just showed you, Nippon Nifty Index, Nifty Bees, Bank Nifty Bees. So those are basically ETFs. Now what are ETNs? ETNs basically track the government bonds instead of the stocks. Okay. Alright, now let's discuss what are leveraged and inverse ETF. ETFs generally track the performance of an underlying basket or index. However, to increase their utility and allow long only investors to express bearish opinions, the industry created inverse ETF. Again, so when do I buy a stock? I buy a stock if I think that the price will go up, right? Now, if I think that the price of the stock will go down, what do? I short sell it, right? So the same way, if you want to go long on an ETF, if you think the price of an ETF will go up, you are going to buy it. Now what if I think that my ETF will go down? There is no option for me to short sell an ETF. What do I do in such situations? In such situations, I will basically buy an inverse ETF. Inverse ETF basically works like short selling only. If I am buying inverse ETF, that means that I think the ETF will go down. Clear? No doubt? Okay. So what is a no risk free basket? The astute analyst might think that constructing a short portfolio of a regular 2 times or 3 times ETF and its inverse counterpart would result in a risk free profit, as both decay over time. This would be true if there were no trends or very shallow trends in the underlying baskets. During a strong trend, the ETF will correct directional bias, will profit according to its leverage. The other ETF will decay, but most likely not enough to offset the gains in its counterpart. So don't think that there is no risk. There is risk still involved. Alright. So now what are REITs? If you want to invest in real estate but you don't want to buy a house, why do I not want to buy a house? Because buying and selling, see, if I want to live in a house or if I want to buy a house for other purpose, it's a good option. if I want to trade in houses, I can't just buy a house, I can just buy land and sell it tomorrow. It is not that liquid, right? It's going to take some time, some sort of time. So if you want a liquid thing where you can put your money in real estate, then there is an ETP, which is known as REIT, Real Estate Investment Trust. In Real Estate Investment Trust, you can basically, it's another exchange traded product only. So they if you have a, if you want a portfolio wherein you are generating money through investing in real estate, you can trade using REIT, which is Real Estate Investment Trust. Okay, what does a technical analyst need? Analysis of ETP is very similar to that of stocks, mainly because ETPs trade on the same exchanges. So you have the same charts, everything is just the same. All you need to do is use the same exact technical analysis like you used in other things. So that's it with my exchange traded products. The only thing you need to keep in mind is what is REIT, Real Estate Investment Trust, and what is the difference between ETFs, exchange traded funds, and ETN, exchange traded notes. Exchange traded funds have an underlying asset, which is the stock itself, whereas your exchange traded notes, the underlying is the bonds. Thank you.